In Chapter 12 of our study of introductory economics, we provide an introduction to our banking system. In this chapter, we're going to give you an overview introduction to the banking system. We're going to take a look at what a bank is and how it functions. We're going to look at the role of the banking system in our economy, and it's a very important role. In addition, we're going to take a look at the brief history of American banking. It's important to do that so that you can really have a feel for how we got to where we are today with the banking system. And speaking of that, we're going to take a look at modern banking as well. Let's start our study with taking a look at what a bank is. And here's your working definition for a bank. It's an institution for receiving, keeping, and lending money. The most important thing to understand about the global banking system, even outside the United States, is that the stability and effective management of the global banking system and the banking systems of all the countries in the world are intertwined and support each other is critical to our survival as a society. Banks have three major functions. Here's the first. They help people store and protect money. Help people and businesses, I should say, store and protect money. Secondly, they help people and businesses manage their money through things like checking accounts, savings accounts, and investment vehicles, such as certificates of deposit. That's really an extension of the savings account function as well. And the third major function is a bank makes loans to businesses and consumers. And it's through the making of loans is where the banks as a business, and we need to remember that banks are for-profit businesses, that's where the bank's largest source of income comes from, is the making of loans. Loans are very important to banks, but they're also very important to our economy. So let's take a little bit deeper look at this and look at some simple loan facts. And when I say they're important to the economy, it's through loans driven through the banking system that we help promote economic growth. It's through loans that new businesses are created. And when new businesses are created, that creates jobs, but also the businesses wind up consuming goods. And when new jobs are created, people get paid, and that also helps to spur on consumer demand. So the combination of the increased consumer demand and also businesses consuming goods drives economic growth in our society. Now, there are four types of loans, and I'll give you a brief overview of them. Here's the first type. It's called a mortgage. It's used to help somebody or a business acquire property, usually in the form of either a house or actually some land. Second type of loan is a business loan, usually used by businesses to acquire equipment, whether it be anything from vehicles to machinery that's used in a manufacturing facility to produce whatever the good is that the business is producing. Third type of loan is a classic consumer loan taken out by individuals to pay for or facilitate the acquisition of anything from a car through somebody's education. And the fourth type of loan is a credit card, and that usually comes as a surprise to some people, but yes, that's all credit cards are. The credit cards are an unsecured short-term loans with very high interest rates. The next thing I'm going to do is to tell you a little bit about how loans work. And this is really important because the likelihood during your lifetime of you going to a bank, either for yourself or maybe for a business that you've established, and going to a bank to take out a loan is very likely. So I don't want you walking in not understanding how some of that works. And The best way to do this is to first familiarize you with some of the terms that are used with relationship to loans. It gives you an idea as to what the loan officer is going to be talking about so that you can converse credibly with them. Here's the first term you should be familiar with. It's called principal. It's the amount borrowed with regard to the loan. The second term you should be familiar with is collateral. These are assets that you pledge to secure the loan in the event possibly that the bank could come back to you and take if you do not pay the loan. Now notice I had mentioned that credit cards are an unsecured short-term loan. With credit cards, they don't ask you for any collateral. However, if you go to take out a mortgage for a home, as an example, they may ask you, they will ask you, what collateral do you have to pledge to secure against the loan? And you may have money in a savings account, or maybe have purchased some stock, or some other type of asset that has value that you can put up and say that, hey, if I don't make good on the mortgage payments, that you can come and take these assets to recover the money that you've loaned. So collateral is an important thing to understand, and to also have some collateral if you can when you go to try to negotiate some terms for a loan. The next term is interest. The bank just doesn't loan out money without charging interest. And interest we call in the business world the cost of money. It's what the bank is going to charge you to be able to borrow the money, which is the loan. The fourth term I'd like you to be familiar with is default. And that's something that you really never want to do, because, and we're going to talk about it here in a couple of minutes, credit records. Default is a failure to pay back a loan, and that's something that could be very debilitating for you personally, and also if you're trying to run a business. It's something you want to avoid at all costs. In our society, it's very important for you to establish a positive relationship with a bank, and there's 3 reasons for that. By establishing and managing a positive relationship with a bank, you are demonstrating your ability to handle your financial responsibilities and obligations. And when you do so, that solidifies your credibility and legitimacy either as an individual or the owner of a business. Secondly, a relationship with a bank in today's world will help you be able to obtain goods and services either personally or for your business through the advanced services that banks provide today. A simple example, it's much easier to transact business with either debit cards or credit cards than it was many years ago, where transactions had to be made with either checks or even before that simply by cash. A third reason is to establish a credit history. And what a credit history is a profile of your performance in handling financial responsibilities. That leads back to this credibility and legitimacy. Now, there are 2 parts to consider to a credit history. Here's the first. It's called the credit report. And what a credit report is a detailed record of your debts and payments. The other part of your credit history is the credit score. This is a number that is calculated, and it's based on your credit history. It gives potential lenders a very quick and simple rating and way to help identify risks that they may have in lending you money. Next thing I'm going to do is give you some facts about credit scores and also tell you a little bit about how they're calculated. But before I do, I'd like to tell you about where credit scores actually come from. There are a number of companies that do credit research and analysis that support the financial industry, banks and other financial institutions, with credit score information. And some of the best known firms in this business are firms such as Fair Isaac Corporation, Experian, and TransUnion. And what they have done over time is they've developed ways of ranking and rating financial responsibilities and performance against them by individuals and businesses. And they've applied their own proprietary mathematical algorithms against those responsibilities to come up with a credit score. Now, in the case of what I'm going to illustrate here for you is I'm going to use what is considered the industry leader, which is the Fair Isaac Corporation's approach to this. And I say industry leader because they were the first to establish credit scores and serve the financial community. So let's take a look at things. The score range is usually between 300 and 850, and that may seem like a little bit of an odd number range to you, but remember, as I had mentioned, it's a specialized algorithm that they use to weight things, and that's what has this number range come out to between 300 and 850. Now, a low score is not a good thing. That shows some real concern over handling financial responsibilities, like if you had a score range of 300. The upper end is a good credit score, so the 850 is considered good. So it goes from low to high. Second, here's some things that make up the score. First, 35% of the score is based upon your payment history, meaning are you making payments and have you made payments on your loans. The next 30% of your score is based on all the outstanding debt that you have, meaning all the types of loans that you have and how much do you have. And by the way, to establish credibility, you really only need one credit card. As a matter of fact, it's looked negatively at if you have more than one credit card, and that'll probably reduce your credit score, even if you don't put anything on the credit cards. You really only need one credit card to establish that legitimacy and credibility. And your balance on the credit card should generally not exceed, on a monthly basis, 25% of its limit. And let me give you a simple example using some simple numbers. If you had a credit card from a bank and it has a $1,000 limit on it, you should probably not carry over $250 worth of charges against it from 1 month to the other. One additional point I forgot to mention on the last slide with regard to the type of debt is that certain types of debt are weighted heavier than others because they are more significant and require, in the eyes of the financial institution, far more attention. Here's a simple example. The financial institutions weigh a mortgage debt that you may have much heavier in terms of importance than against credit card debts. And therefore, if you perform and meet your responsibilities on the more important types of debts, that will help you and help raise your score because of the weight that they put on it. Now, the next point here is that 15% of the score is based upon the length of time you have had credit. Obviously, if you demonstrate accountability and responsibility over longer periods of time, you have a stronger profile, and they recognize that and reward that accordingly. So I guess the short of it is older people will probably have a tendency to have a higher credit score than younger people because they have been able to demonstrate responsibility over longer periods of time. The next point is that 10% of the score is based on the number of inquiries against your report. Now, this might be bad for your score because it may indicate that you're in some kind of financial trouble and you're looking for money or not able to effectively control your spending. 10% is not all that much to worry about, but here let me give you an example of how you can be attentive to that. If you're in the market for a new car and you're going to finance it, meaning taking out a loan, choose a number of potential financial loan providers that you may want to work with, as opposed to a vast number, like 3 or 4 that you would go to, as opposed to 10 or 12. That will wind up, the 10 or 12 would wind up having a more negative effect against your credit rating, because when you go and apply for the loan, that winds up becoming an inquiry against your credit report, because they're going to run a credit score on you. So 10% is not a lot, but just be a little bit attentive to that. The last 10% of the credit score is based upon the types of credit that you have. A few moments ago, I had mentioned that the financial institutions weight certain types of debt more heavily than others in the score, like a mortgage versus credit cards. If you've established a credit history with a number of different types of credit and shown that you've been able to handle the responsibilities well across all the different weighting types, that's going to work in your benefit in this case. Next, what the credit score affects. Well, there's quite a few things, the last point of which usually comes as a surprise to many people. Well, the first thing that it will affect is whether you'll get a loan or not, and I think that would be pretty understandable. Second, it will also affect what the interest rate may be. For example, if you have something questionable in your credit history, the bank may still be willing to give you a loan, but maybe not at a prime rate or an attractive, something a little bit higher to cover their risk in offering you the loan. So it will have an impact on interest rates. Now here's the thing that surprises people. It may affect your possible employment, because in today's world, with the technology access to all kinds of information, when you go to apply for a job somewhere, your new employer or potential employer is very likely to run your credit score to see what kind of individual you are in handling terms of responsibility and what your credibility is. And there have been cases where, plenty of cases where people have been denied employment because their financial history, management history, reveals a lot about them personally. This could even have an impact on you in looking for housing. I know that many landlords who have rental homes and apartments, houses and apartments, will actually run credit scores on potential renters for their property. So our society uses credit scores in a wide variety of ways. It's just not the financial institutions these days. Let's now take a look at 2 examples of credit scores. And the 2 people that we'll look at in this example, we're going to assume that they both have several major credit cards, a mortgage, a car loan, and student loans. So right off the bat, we can tell something probably about these people from an age standpoint. They're probably not in their early 20s. At best, they're in their early 30s and probably a little bit older. The first person we'll look at is somebody with a 780 score. Now, before I give you some of the characteristics about this person with regard to their credit record, let me point out something. I know I told you the upper end of the credit score range is in the 800s. I hadn't mentioned so far that it's almost impossible to have a perfect credit score, and you'll see with this person, at a 780, they haven't even broken through the 800 threshold yet. So just keep that in mind. It's almost impossible to do that. So here's what the person with the 780 score looks like. They have at least 10 credit accounts in total and have put together a 15-year credit history. Second, they use only 15 to 25% of their credit card limits. So if you remember my recommendation, they watch that closely, and these people certainly are managing their credit cards well. They have no late payments on their credit report, and they have not at any point in time gone into collection with regard to any of their debt, and they have no other negatives on their record. Now here's our second example, and this is a person with a credit score of 660. Obviously 120 points below the person that we just looked at. So let's see what differences there are here between these two individuals. Well, this person has six credit accounts, not as extensive a credit portfolio, and an 8-year credit history, a little bit less than the previous person. So not as much of a proven entity. Okay. The second thing is they use 40 to 50% of their credit card limits. Now that's significantly more, certainly not maxing out their credit card, but more than the prior person, and that will have an effect on the score. But here's where they really differentiate themselves from the other person. They were 90 days late on one credit account 2 years ago, and 30 days late on another account 1 year ago. And that has taken a fairly significant toll on their credit score. So there's two examples for you. So what do these scores mean, or let's put them in a ranking generally to let you know how the financial institutions rate these types of scores. First, if you're 750 or above, a financial institution would look at your credit record as generally being excellent. If you're in the 660 to 749 range, they consider you good. And probably in the excellent and good category, you shouldn't have too much trouble getting a loan. Like, for example, if you wanted to get a mortgage or something, bigger along those lines, you'd probably qualify. The person who has a good rating may not get as good an interest rate as the person that would get and that has the excellent rating, but you would certainly qualify. A fair rating would be, or ranking would be, between 620 and 659. And in today's credit markets, it may be difficult to qualify for either a business loan or a mortgage, something of bigger stature, if you will, in terms of your debt load. And if you do happen to qualify, it'll probably be at a higher interest rate. And the last ranking category would be poor, somebody that has between a 300 and 619 credit score. And it's very likely, again, in today's credit markets, that an individual with this type of credit score would not be able to secure financing or loans. So let me summarize here with regard to credit scores and credit reports and the like. There are 5 things that are absolutely guaranteed to destroy your credit score, and you should avoid at all possible costs. First is actually maxing out a credit card, meaning going up to the entire limits that you have on the card. For example, if you have a $2,000 credit limit on a card, actually going and putting $2,000 worth of charges on it. That will take a significant hit to your credit score. And that's probably the least damaging thing. The next set of things I'm going to talk about, the other 4, are the ones that will really completely destroy your credit score. So the second one here is skipping any loan payment whatsoever, meaning where you just don't pay what's due. That will completely destroy your credit score. Settling or negotiating a credit card debt. Now, I'm sure you've all seen on television advertisements for firms that are offering to get creditors off your back and consolidate loans and negotiate payment settlements for you if you happen to put yourself in the position of being overburdened. I highly recommend that you not do that, because what you're licensing that organization to do is negotiate a debt for a settlement of a debt for you, and that will have a devastating effect on your credit score. So avoid that at all possible costs. foreclosure on a piece of property or a home. And what foreclosure is, if you're not familiar with it, is actually walking away from the asset and what you own and not paying the loan that's associated with it. Foreclosure will destroy that. And finally, filing for personal bankruptcy will also put you in that case, because with bankruptcy, what you're doing is settling all your outstanding loans and trying to walk away from that to get the creditors away from you, and that will have a negative effect as well. So the question becomes, can you ever recover if you happen to mess up with regard to falling into one of those categories of things that can destroy your credit record? And you can somewhat, but you'll never completely recover because the evidence of mismanagement will always be there. Let's use that person that was at the 780 credit score example. If something happened where they took some actions that would hurt their credit score, like missing payments or a foreclosure or something that I had just mentioned before, their credit ranking would be certainly lowered, and they would never be able to get back up to that 780 level again. I mean, you could improve your record somewhat, but it will never reach that same level that you had when you had a fairly pristine credit record level. Okay, enough about credit scores, credit reports, and your deep personal relationship with the banking system. Let's step back for a second and take a look at an overview of how the banking system is organized and how it works. And we'll start with identifying the types of banks. The first type of bank is one that you're probably very familiar with. These are the banks you, for lack of a better way to describe it, you see on the street corner, the retail and commercial banks. The likes of Wells Fargo, Bank of America. These provide classic banking functions that serve businesses and consumers with their daily banking needs. The second type of bank you may also be familiar with. They're finance companies and credit unions. And they provide banking services similar to a retail and commercial bank, but maybe specialized in serving a particular section of a community. Some examples here are Countrywide, which is actually now, as a finance company, it's owned by Bank of America and specializes in certain types of financial supports for consumers, and AEA Federal. The third type of bank are brokerage companies, and what we mean by brokerage companies are stock and bond brokerage companies. And the reason why we consider them a bank is, first of all, they're a financial institution, but secondly, they do provide some classic banking functions for serving consumers who do business with them based upon their brokerage relationship. For example, if you have a rather large stock portfolio that has a significant amount of money invested into it, and you're in need of a loan, you could go to your brokerage company and actually borrow against your account. They will loan you money, just the way a bank would, against your assets that you have deposited with them. There are lots of different brokerage companies. Some examples here are Edward Jones and the online brokerage company E-Trade. The next type of bank is a classic investment banks, because there's a separate type of investment bank that's a classic investment bank. Investment banks deal with businesses only, and they're in the business to promote business growth. Okay, they do not deal with consumers or individuals. And there are two types of investment banks. The first type is called a venture capital fund. And these investment banks focus on putting money or loaning money to startup companies. And what a venture capital fund is really a group of people that have a significant amount of money that get together in a partnership approach to create this fund or investment bank where they pool their money together and make investments in new up-and-coming businesses. The two examples that I have listed here, Kleiner Perkins and Sequoia Capital, happen to be two of the most prominent venture capital funds based in California, up in the Silicon Valley area, that have done many of the investments in startup companies in the high-tech industry. And here's the reason I corrected myself a moment ago when I started to talk about investment banks, because there is what we call a classic investment bank. These are much bigger institutions than venture capital funds, and their focus is in really three areas. The first is providing big corporations with big business loans for things like expansion. If a company wants to, instead of taking money out of their profits, they want to borrow money to build a factory in another country, they may go to their classic investment bank for that type of loan. The second thing they do, the classic investment banks, is provide financial support to corporations that are either merging together, or if one corporation is trying to acquire another. So mergers and acquisitions they get involved with quite often. And the third function of a classic investment bank is that when a small to mid-sized company is looking to go public with an initial or even a supplementary stock offering, a classic business investment bank will handle the underwriting and setting up the market for the stock offering for a company. And when they do that, especially if it's an initial public offering of stock, they'll work very closely with the venture capital fund that I had mentioned a moment ago. Some examples of classic investment banks that are well known: Morgan Stanley and Credit Suisse. In our overview, the last type of bank I want to mention here is the Central Bank of the United States. And we're just going to hit on a couple of highlights with regard to this type of bank, because we're going to study this in more depth in Chapter 19. Every industrialized country in the world, the advanced societies and advanced countries, has a central bank, and they work a little bit differently. The Central Bank of the United States is a very unique institution. It's called the Federal Reserve Bank. Many people mistake this bank as part of the federal government or an arm of the federal government, and it's not. I'm going to highlight 5 facts right now with regard to the Federal Reserve Bank as the central bank of the United States. It's actually a corporation. It's not owned by the government. It's owned by member banks through stock that they actually purchase in the Federal Reserve System. The leader and the board for the bank, the board of directors, are appointed by the President of the United States with the approval of the Senate. However, the general management of the bank underneath the board is actually elected by the owners, meaning the banks that own the company through the corporation through the stock. So this mix of relationship with the government and acting as a classic bank as a corporation is a very unique role and profile for this type of institution in our society. The third of the 5 facts with regard to the Central Bank of the United States is that the Federal Reserve Bank acts as the classic bank for the federal government. Just as you would have a personal relationship with a bank for banking services like a Wells Fargo or Bank of America, or a business would have the same type of relationship, the federal government has that relationship with the Federal Reserve. The fourth fact is that the Federal Reserve regulates and supervises all the banks in the United States and all banking functions. It also manages the money supply for our economy, which is a really big and important role. it manages interest rates, and it acts as the agent for the government in the government's cases where it needs to borrow money. This is a very unique institution. It also is a very powerful institution. And I like to joke, although it really probably isn't very funny, it's probably very true, that the Federal Reserve Bank here in the United States has almost as much control over your life with the things that it manages and can have an effect on as the oil guys, the Organization of Petroleum Exporting Countries, and how they set prices for oil, and that affects everything. Well, there is somebody that runs the Federal Reserve Bank and system. It's a lady, and some people actually claim it makes her more powerful than the President of the United States, and that's the recently appointed Janet Yellen, who is the chairperson of the Federal Reserve. In order to have a deeper understanding of why our banking system looks the way it does today and operates the way it does today, it would be worth our while to spend just a couple of minutes looking back at the important stages of development of the United States banking system. And there are 6 important stages to look at. Just before the country was created, back in colonial times, the banking system operated as the way it did in Europe. It was really an informal side business for merchants. And in the post-revolutionary era, we had a need to create a more stable banking system than had existed during the colonial times. And the topic of a stable banking system and what it would look like and how it would be organized was a great priority to the founding fathers of the United States, and created a great debate because there were 2 competing philosophies. One of the philosophical groups was championed or led by Alexander Hamilton, and this group was known as the Federalists. They were in favor of establishing a formal, more structured banking system and creating a central bank of the United States to serve the government, much like in some ways, the Federal Reserve Bank does today. The other competing philosophical group were the Anti-Federalists, who were led by Thomas Jefferson. And they were against having a formal structured system for banking. They wanted to be closer to the way things were done during the colonial era, where it was a much looser arrangement as a side business for merchants. In this debate, the Federalists won the first round of this, and if you see the date here regarding the dates regarding the first and second national banks, agreement was made by the leaders in 1791 to go ahead with the creation of a formal banking system and create a central national bank. And the United States Congress issued a charter for 20 years for that system to operate and be governed by the central bank. Now you see there was a period between 1811 and 1816 where Thomas Jefferson became President of the United States. The formal banking system was scrapped during that period in favor of the more open and less controlled approach, and the results during that short period of time were an unmitigated disaster, which is the reason we went back to a formal centralized system around 1816, which continued through to the Jacksonian era in 1836, where we went back to the anti-federalist philosophies with the same disastrous results. So let's take a look at the first and second national banks and see what kind of structure was put into the formal banking system. The central bank that was created during those periods held the tax money collected by the Treasury and paid the government's bills just as the Federal Reserve Bank does today for the federal government. The first and second national banks also helped the government borrow money through the sale of bonds when needed in the public's interest. It issued a national currency that was representative money at the time and that was backed by gold and silver. And the first and second national banks were responsible for chartering banks, and if you're not familiar with the way the word chartering is being used here, it means that the first and second national banks gave licenses to other banks around the country to operate and conduct business. And the first and second national banks were also responsible for supervising those banks' business practices. In other words, how they loaned money and conducted all their affairs. And the last function that the First and Second National Bank had was the ability to impose reserve requirements. Effectively, they created the fractional banking system that we're familiar with today. What a reserve requirement is requiring a bank to hold a percent of its deposits in reserve, or meaning in the safe, where they couldn't loan a certain percentage of the money that's deposited with them out in terms of loans to make money. And the idea behind this was to keep some money on hand to prevent something that we call a bank run or panic. This is a situation that might occur where, based upon anything from a rumor to changes in economic and business conditions, the public panics a little bit. They feel as though they're going to lose their money. They show up at the bank in rather large numbers demanding to withdraw their money. And if the bank doesn't have enough money on hand to do that, it leads to a bank collapse. And by having some money held in reserve, this helps mitigate that problem or reduce the likelihood of that happening. So the reserve requirement played an important role. Let's now take a quick look at the two periods of what we call bank chaos in the United States. That's those periods I'd mentioned a few minutes ago, between 1811 and 16, and then after 1837 up to the Civil War period in the United States. And this was the period of time where there was no structure to the banking system, no formal supervision. And the reason for that is there was no central bank. The Congress of the United States had withdrawn its charter. And the first characteristic of this period tells a little bit about who was in charge. The responsibility for banking fell to the states. And quite frankly, the states did their own thing individually and got out of control as they went about chartering banks to almost anybody. By the period of the Civil War, we had over 8,000 banks in the United States. And granted, some may have been run by people who understood how to manage and run a bank, but there were an awful lot that were where we had licenses and charters issued to unqualified people. And the United States certainly did not need upwards of 8,000 banks at that point in its history. The way unqualified people got involved is that if you happen to have known a state legislator, you could probably go and offer that person some cash for who knows what, campaign purposes or whatever, or just a straight up bribe, and they would wind up issuing you a license to run a bank regardless of whether you were qualified or not. And when you have unscrupulous people looking to make a quick buck and also not knowing how to properly run a bank, which is based upon trust and credit, you wind up having massive fraud and something that we call wildcat banks showing up. And what a wildcat bank would be was that somebody who was looking to make a quick buck and wound up getting a bank license would show up in some town, put up a sign outside of a storefront, start to operate the bank and take in deposits for a few months or half a year, and then mysteriously one day disappear with all the depositors' money. Didn't exactly lead to a lot of building confidence in the banking system. The second characteristic of this period is that these 8,000 banks were issuing their own money. That was not being controlled either. And that led to a lot of problems in that the money from some banks was not accepted by merchants or other banks for that matter. Here's a classic case. Cattle ranchers in the western portion of the country in their annual cattle drive and bringing their cattle to the Midwest for slaughtering and so forth. They'd show up in either like St. Louis or Chicago. And the cattle rancher would wind up going to a local store or merchant in one of those cities or urban areas and look to get some supplies for his crew and himself, maybe for their return trip back to the cattle ranch. And they would present money to the merchant based upon the bank that they had a relationship with back in their home territory. But because of wildcat banks and fraud, the merchant in the city may not be familiar with the bank in the cattle rancher's local area and would actually refuse to take the money that the cattle rancher had in payment for the supplies that they needed. It's amazing that the country was able to still flourish and progress ahead and grow given these crazy conditions of having the fraud situations, the lack of confidence in the money system, and the like. The states also did not see the need to maintain the good business practice for a bank of a reserve requirement, and that wound up leading to an increase in bank runs that became pretty severe by the time we reached the Civil War era in the country. And all these things combined deteriorated the confidence in the banking system and led to some big economic slowdowns. I mentioned a moment ago that the country still grew in spite of this, but it actually could have prospered and grown much quicker and much more if it wasn't for these two periods of bank chaos in the United States. During the second half of the 1800s in the United States, we have the period of unification, and the government took two important actions. The first one was the passage of the National Banking Acts. Now, you would think that the federal government would go back to the central bank approach, but it didn't do this. It took a little bit different route in giving the Federal Treasury Department three important powers. The first was the power to charter banks, which was a good thing. That type of supervision was sorely needed after our experience in the two periods of bank chaos. And also the power to set reserve requirements on the chartered banks. And that obviously was designed to help reduce the problem with bank runs. And the third power that was given to the Federal Treasury was the authority to issue a single currency and get rid of the 8,000 plus forms of currency and money that we had in the United States. And this was still representative money backed by gold and silver, and it became known as the greenbacks. And the reason for that and the history behind that is this was the first time that money was printed under the government's authority, a single currency, where the actual bills had the green type oriented ink that you are familiar with today, that you see still in our money system. And here's the second thing that the federal government did during the period of unification that was important. As I mentioned just a moment ago, creating one single currency, the greenback, and I said it was representative money. In 1870, we moved exclusively to what we call the gold standard as far as what backs our money. And that provided us with three advantages at the time. It set a definite value for our money, and it was based upon the gold. It prevented the government from printing too much money, and therefore it inspired confidence because we had a strong, stable currency. So that leads us to this question: was what was still missing from the banking system, if you will, that could complete the picture to bring us up to where we are today? And I think you could probably guess what that is actually moving back to the functions of the original First and Second National Bank, which are the things that we do have today in the Federal Reserve Bank. So let's go there now and look at how that picture was completed and when it was completed. So here are the missing functions that still haven't brought us back to the First and Second National Bank type of structure for the banking system. And it really boils down to three missing functions and authorities. First, supervision of the banks and the money supply that was independent of politics. Remember, the Treasury Department was given these authorities after the Civil War during the period of unification. And the Treasury Department employees are beholden to the elected officials. So you run this risk of having some degree of political influence here, and plus the fact that the Treasury Department is an agency of the government, again run by political officials. Today's Federal Reserve, if you remember from earlier in this chapter, is an institution outside of the political process because it is not a governmental agency. In functioning in that way, it inspires far more confidence in not only the financial system and the economy, in that it's removed from the specter of potential political influence. The second missing function was classic banking functions to serve the government in holding the taxes that were collected and independent government payment systems. Effectively, during the period of unification with the National Banking Act, you had the Treasury Department holding the taxes collected and providing the payment systems. So, in other words, the government, if it was going to write checks to pay for something, was writing checks upon itself. Now, let me give you an example of why that doesn't work. Let's say you were going to go down to a merchant in town and either pay for something that you want to buy with a personal check or your own debit card that has the Bank of You listed on it. And the merchant takes it and takes a look at the debit card or the check and see that you're writing a check on yourself, your own, personal bank. I guarantee you that that merchant is going to be a little bit skeptical or question whether the money really exists in the account to make good on the payment. So again, independence, and that's why the Federal Reserve today is set up independently to hold the money away from the political system and away from the government. And the third function was supporting secondary level banking functions to serve chartered banks in particular. Things like check clearing and short-term loans. To explain check clearing here would be too long. Be sure to check in on my discussion about that in the course resource center. I'll explain how old-fashioned check clearing works. That's a little bit antiquated today because of the extensive use of debit cards, and there's not really a need for a check clearing process, as electronically money is taken right out almost immediately, if not immediately, out of your checking account to pay for something when you use a debit card. However, there are still checks floating around and being used in our society, and I'll be explaining the check clearing process. Also, short-term loans, when banks need to borrow money to make sure they're meeting their reserve requirements, there was no ability through the Treasury Department to provide that the way we do have it today with the Federal Reserve System. So these missing functions were addressed, and we entered the period of 20th century banking with the proper supervisions and controls in 1913 when the Federal Reserve System was established. And with the establishment of the Federal Reserve System and a central bank, we have politically independent management of the banking system and many of the other functions that were missing, like classic central bank functions such as providing chartered banks with short-term loans as the lender of last resort, check clearing for all banks, payment systems for the federal government, the authority to set reserve requirements, and the authority to borrow money on behalf of the government through the sale of treasury bonds and bills. And also, very importantly, it was the creation of the Federal Reserve System in 1913 where we made a shift with regard to our money. And we moved from representative money to fiat money, and the bank got full responsibility for management of the money supply. To complete the picture of the banking system that we have today, I want to touch upon just a couple of reforms that were made to the system out of the Great Depression era. Probably the two most significant are the following. First is that the federal government decided to set up an agency that's called the FDIC, the Federal Deposit Insurance Corporation. It's not a corporation in the sense of the way we've studied corporations during Chapter 9 in the Business Organizations chapter. The term is used a little bit loosely, in part because there's fees that are paid into the FDIC to help build this insurance fund. And what this does, it was designed to instill confidence on behalf of the public in the banking system. And the government set this insurance fund up so that if you have upwards, in today's world, upwards of $250,000 deposited with a bank, and for some reason the bank fails, that you would be insured by the government to get at least $250,000, if that's what you had in there, returned to you. If it's obviously less, you would get whatever you had in your account returned. Now, the other side of that coin is if you have more than $250,000 in savings or deposits, you'll probably want to spread that out across a couple of financial institutions or banks to reduce your exposure and risk if you believe that banks are at risk of going into default. Now, we have had very few bank failures since the Great Depression. However, the latest bout of that occurred during the 2008 Great Recession, but it's still a pretty rare occurrence. But this function does exist to help instill confidence in the banking system. The second reform that came out of the Great Depression era is that back before this time, banks could offer a wide variety of financial services, not only traditional banking services, but they could also offer stock brokerage and bond services. So the federal government saw fit, coming out of the market crash in 1929, when the government passed the Glass-Steagall Act that separated banking and brokerage into two separate businesses. And this was really to separate out commercial and retail banking from investment banking and its involvement in financing of corporations and new corporations. However, this act was repealed in the 1990s because the whole, not only the economy, but also the nature and operations of the banking industry and the types of firms and the products and services that are offered had changed rather dramatically. That brings us to an end to Chapter 12, the banking chapter. Chapter 13 is coming up next. It's all about the financial markets and financial products, and we look forward to seeing you there.